the United States is very expensive. Even our legitimate companies, the ones that actually do have earnings and pay dividends, they're generally twice as expensive as a similarly situated company in Europe or Asia. So you get much better valuations, and investors are going to be more focused on valuation now. I mean, that's one of the reasons that a lot of these stocks, like look at Facebook, they came up with bad earnings, the stock drops 25% in one day. Same thing with a PayPal. Because the valuations are so high, if you just miss expectations by a small amount, you're going to get completely clobbered in this market where we're starting to revalue stocks at lower multiples because we're no longer in this low inflation environment. We're in a high inflation environment, and what people still don't understand is that this high inflation environment is here to stay because there's absolutely nothing the Fed is capable of doing about it. In fact, everything the Fed does is going to throw gasoline on the inflation fire. So Fed monetary policy is going to exacerbate the inflation that we're dealing with. I mean, even though they're talking about fighting inflation, they're not really going to fight it. They're going to keep stoking the flames, just they're going to be less aggressive. What they're talking about doing is raising interest rates from 0, where they are now, up to maybe 1% by the end of this year, and maybe up to 2% by the end of next year. But these are still highly stimulative rates of interest. It was in 2002 that the Fed slashed rates to 1% to stimulate the economy after the NASDAQ bubble burst, and after we had the terrorist attacks in 9/11, and we started the war on terror, and all that stuff happened. We had a recession, and so Greenspan lowered rates to 1 to stimulate the economy. Now Powell's saying, well, we're going to raise rates to 1 to sedate the economy. I mean, it's still low, and the Fed is still printing money. And the problem is the budget deficits have exploded. We're talking about maybe $3 trillion a year now is what our annual budget deficit is. The only way to finance that is for the Fed to do more QE. So even though it's talking about shrinking the balance sheet, it's not really going to happen. The balance sheet is going to keep expanding. But not only do we have this huge budget deficit, we have record trade deficits. Last year, we had the first ever merchandise trade deficit to exceed $1 trillion in a single year. And in the month of December, we hit a new record high. We had over a $100 billion deficit in December, and these deficits are going to skyrocket. Look at the price of oil, now $92, $93 a barrel, heading well above $100 a barrel this year. We're net importing a lot of oil. That further runs up the trade deficit. So there's no way to finance this. The Fed is going to be forced to print even more money. So while it's pretending it's going to take the punch bowl away, it's going to continue to spike it, but it's not going to be enough to sustain the asset bubble. So the change in monetary policy is a significant enough shift to prick the bubble in tech stocks and momentum stocks, but it's not big enough to slow down inflation. So we're going to have stagflation, we're going to have a weakening economy, rising inflation, and that is a very different investment landscape than the one investors have been used to over the past 10, 20 years.
Prices of, let's say, the Apple Pencil go from $100 to $110. We got 10% inflation. Do you believe that companies have the pricing power to keep raising these prices to where that pencil goes to $115, $120, $125, and it actually just continues to go up? Is this not potentially just a one-time set of, that's it, the Apple Pencil went from 100 to 110, we had our 10% for a year, and now we go back to, the 1, 2, 3%. Do you think that 1 to 2% interest is still so accommodative that we're actually going to still see 7+% prints on CPI?
Yeah, well, because the cost of making those pencils is going to keep going up. Maybe 10% a year, maybe more. So the manufacturers are going to have to pass on those higher costs to their customers because they have to operate at a profit. So at a minimum, they have to pass on the costs, but what they end up doing is actually passing on more than the cost, because you have to find a new equilibrium. Because every time the company raises prices, it does lose some buyers on the margin, because we're all sensitive to price. I mean, if we weren't sensitive, the companies would just jack the prices even higher. The reason that there's a lid on prices is because companies are looking for the optimal price where they can sell the most amount of stuff and make the most amount of money. And so as you raise prices, you start losing some of your customers. So there's a sweet spot where you can have the maximum amount of profit. Well, that all changes when your costs go up. So when their costs go up, they have to find a new equilibrium where they can maximize their profits. But what happens is as you start raising your prices, you start losing some customers. And so now you have fewer customers to try to average out all your fixed costs. So the new equilibrium price where you can maximize your profits ends up being even higher than just the increase of costs, because you have to make up for the loss of customers. So what happens in an inflationary environment is businesses keep selling fewer and fewer products at higher and higher prices, and those customers that can afford the higher prices keep buying, and those that can't, well, they go without the products. I mean, think about the oil market. Oil topped out at $150 a barrel in the last bull market, and it topped out in 2008. The Fed funds rate was 6.25 at that time. That's how high 6.25. It's a quarter right now. It's 25 basis points. All right, look how much room we have to raise interest rates before we get to a point where oil might peak out. And also the dollar index in the summer of 07 was about 73. It's 95 now. So we had a much weaker dollar back then. We have almost $100 oil now with a strong dollar. So if you figure we're starting a cycle where the dollar is going to start falling and interest rates are going to start rising, how high will interest rates get and how long will it take to get there, and how low will the dollar be before oil peaks again? I mean, I think you could be looking at a $300 oil price before you get another big drop.